welcome to Step Into My Office, Commercial Property Executives podcast series that tackles all things office and flex office related. Join me and industry experts in the field as we take some trips across major markets and delve into investment strategies and opportunities in the sector. I'm Olivia Bunescu, Senior Associate Editor, and for this episode, I'm joined by Allison Kelly, Senior Vice President at CBRE, to discuss Orange County's office market and what is driving its recovery. We talk about the market's stabilizing fundamentals, the occupiers leading leasing activity, the submarkets seeing the strongest momentum, capital market conditions, flex office trends, and why Class A assets continue to outperform. Thank you very much, Allison, for accepting my invitation to Step Into My Office, our podcast series that tackles everything office and flex office related across major markets in the US.
Thank you for having me, Olivia. It's wonderful to be here.
Today, we're going to discuss a bit about Orange County. And to start, how would you describe Orange County's office market right now?
So I would describe Orange County's office market as continuing to stabilize with a lot of activity in different segments of the office market that are making it really very exciting and dynamic overall. Just for a few statistics, our availability rate continues to come down. So last quarter, we posted an 18% availability rate. That is down significantly from when we peaked in the first quarter of 2025 at 24%. Our sublease space inventory is continuing to declined another 300,000 square feet last quarter. Our vacancy is remaining relatively flat at about 13%. And we are still seeing companies continue to right size, which has continued to result in negative absorption, but it's getting less and less. By way of example, in Q1, we were negative 347,000 square feet of negative net absorption. Last quarter, we were at negative 116 and 500 square feet of negative absorption. So we're seeing that trending in a positive direction, and it just takes time to work through all of the supply.
And how does the market's office recovery compare to nearby Southern California markets such as Los Angeles, Inland Empire, or San Diego? What's specific to Orange County?
So I would say Orange County is incredibly entrepreneurial. And it's made up of this beautiful combination of large corporate companies that everybody knows that are publicly traded, and then also a lot of very high growth companies that are founded grassroots here in Orange County. And those are really in diverse industries from, medical device and pharmaceuticals to home building and real estate, technology, companies in the financial sector, on and on. So I think compared to some of our other neighbors, we've had kind of a holistic recovery that you could attribute to a lot of different industries. Certainly in the news lately has been one of our major growing industries, and really one company in particular, Anduril, in the defense technology space. And they have absorbed a remarkable amount of space, more so in the industrial arena than just pure office. But nevertheless, they have, over 1 million square feet of office space as well, which is actually creating a really interesting opportunity in the capital market space within Orange County as a couple of those properties come to market with long-term leases in place with Anduril, which is generating a lot of activity from, the high net worth investors and the institutions alike. So that will be very exciting to watch. But back to your question, I would say it's really our recovery is really rooted in the diversity of our occupier base and its kind of continual growth in different segments.
And what types of occupiers are most active in Orange County right now, and which industry are still hesitating when it comes to making long-term office decisions?
So one of our really active industries is healthcare. A big example of this is Hoag Hospital, which is one of our major regional hospitals here in Orange County. They recently purchased a 1 million square foot campus from the GSA down in South Orange County for $207 million. That will be another campus that they ultimately build out over the next 40 years or so, but a long-term strategic play for their continued growth. In the healthcare space, we've also seen City of Hope continue to grow in our market, Memorial Care, Kaiser, Providence, really all the major health systems. So a lot of focus in that healthcare space. A lot of that is also fueled by University of California, Irvine, UCI, which is our major academic center here in Orange County. And we've had a lot of medical device, ophthalmology type companies, et cetera, that have been developed out of students and research and all that exciting innovation that's happening on the UCI campus. So in addition to kind of the healthcare systems, I would say medical device, technology, but then branching out from that, logistics companies, financial kind of sector, financial services companies, home builders. Let's see, this last quarter, Wells Fargo Bank renewed another 50,000 feet in the market. Redwood Trust, which is also in the financial services world, another 40,000. Pharma, Becton Dickinson expanded into another 42,000 feet within South Orange County. Yeah, so it's really across the board, which is exciting. And I think for investors, as they think about this environment, should give them some excitement and interest and really a level of comfort that long-term, Orange County is a very diverse environment with a lot of growth.
The occupiers paired with the figures, the CBRE figures that you mentioned earlier regarding vacancy and negative absorption and asking rents, what do this tell you about the health of the Orange County office market, specifically post-pandemic when the office market had, like a bit of a slower recovery?
Yeah, I think it's fair to say that the market is continuing to stabilize. I think, once you're getting into vacancy rates that are close to 10%, that's generally considered a stabilized and a healthy market environment. So I think within, the next 12 to 24 months, we are going to start to see growth again in rents, I think finally our negative absorption will start to be replaced with some positive absorption. So I think that's where we are. I think really as we think about the next 1 to 5 years, we're going to be heading into growth and a positive trajectory overall.
Which Orange County submarkets are showing the strongest office leasing momentum today, and what exactly is driving that activity?
Sure. So our largest submarket within Orange County is called the Greater Airport area, and that is the area right around John Wayne Airport. It's over 50 million square feet, so roughly half of the entire base. That would be kind of considered the center. So we have very strong activity in the core of the market. It's very close to a lot of the executive and decision maker housing, which I know is an old school concept, but it still definitely drives decisions and why people choose to locate their businesses where they do. So I would say the airport area, and then really South Orange County has been our area with the newest product. And so that flight to quality that continues, that is mostly taking place in the airport area with a few newer projects that Trammell Crow built, Lincoln Property Company, and then really all of the newer development over the last 10 years has been with the Irvine Company as well in the Irvine Spectrum area. And what really drives the Irvine Spectrum segment of the South Orange County market, which is over 20 million square feet, is that it's right at the heart of the 405 and the 5 freeways. So for any California vets, we love to use our freeways to talk about what's where and when you'll be somewhere. And it doesn't get much better in terms of being at kind of a central or like a there than the crossing of the 405 and the 5 freeways, which is right in the center of the Irvine spectrum. So those have really been our most active, highest rent, the areas where you have interest from the best capitalized type companies.
And could you also touch a bit on the main challenges operators and landlords are facing in Orange County right now?
So that brings a really interesting point, Olivia. We really have two dynamics happening on the ownership side of the office market. We have our long-term, really well-capitalized owners, and our best example here is the Irvine Company, with them owning over, 35% of the market. They are definitely our 100-pound gorilla. They look at assets on a 100-year hold basis. They generally have a very low land basis because it's all part of the Irvine Ranch, except for a couple assets they've acquired over time. But for the most part, it's all Irvine Ranch land that they've owned for decades that they've developed. So when they're looking at their assets, they're investing for the long term. And this is really attractive to to occupiers, because it's stability. They know capital is going to continue to be reinvested in these properties. And so that's, really part of our flight to quality story is in assets like these that are owned by the Irvine Company. So I think a dynamic for a group like that, if they were to have one, they're highly successful, is really just the cost, right? So the cost of tenant improvements and construction and reinvesting in their assets, from kind of the basic roof, HVAC, kind of all the back of house systems, to the more exciting things that we like, right? The nice coffee shops and the food services and the beautiful fitness facilities and conferencing space and all those things. Costs are not going down. I don't think they're ever going to go back down. And rents have not appreciated that much to keep up with those costs. So that's definitely a dynamic. So we have kind of that really long-term horizon type owner in our market. And then we have properties that were maybe purchased right before COVID. The pricing was higher when they purchased, therefore their debt was higher. And some of those have been reshuffled where they've gone back to the lenders, and they're now, properties that are trading for significantly lower than what they were last purchased for. The buyer group that is primarily acquiring these are the high net worth investors. And these folks, family offices, etc., are going to do fabulous because they're making money on the buy. So, they're buying, when you look at kind of the long-term horizon, historical and future, they're buying really in the low segment of the market. I think we're kind of through that at this point, but there have been really good basis plays that are available. And ultimately, they can hold these long term. They can sell these 5-7 years down the road, and there will definitely be a spread in their favor. These ownerships generally do not want to spend the same amount of capital that an Irvine Company type professional long-term owner of, a real estate portfolio wants to. And so the dynamic there is really opportunities that might be a bit lower cost. There's also likely going to be less capital, TI money, etc., available to the occupier, but also maybe a lower occupancy cost overall. So there's certainly a market for occupiers that, prefer that kind of a model. But you really have this tale of two ownership structures. I think both will be successful. Both will end up making a lot of money, but it is just a different headspace and mindset, and also a different occupier experience for their tenants.
I've actually had Irvine Company as sources for my co-working Outlook article this year.
Oh,
So
good.
yeah, I worked with them previously, so I'm very
Fabulous.
familiar with them. Is there anything on the capital markets conditions worth mentioning when it comes to Orange County, besides the tale of the two ownership structures that you mentioned?
So really, the institutional capital has not re-entered the office market from an acquisition standpoint in Orange County. I think they're missing out because I think this is an opportunity where they could be purchasing at really favorable basis and with their kind of professional way they think about real estate, with their kind of global or national purview, how to position assets, et cetera. I think they could be really taking advantage of some interesting opportunities. But it's more of a herd mentality when you get into the institutional space. So office is pretty close to last on the list for most investment groups. And so that hasn't shifted yet. We do have a property under contract that would be, I think, kind of a quasi high net worth, but still kind of a little more institutional. They have a big portfolio. I think we are starting to see some inklings of the re-entering of the market. I think this group will kind of be the first, and I think they'll be happy they did. I think it's going to be a great investment for them. I will say, as I mentioned at the top of the call when we were talking about Anduril, as we start to look at some of these single tenant, triple net leased kind of investment deals, I do think that we're going to start to see more institutional capital take a look at those because they're more risk averse than a multi-tenant, 50% leased asset that needs a lot of TLC to get it to stabilization.
I'd like to move the discussion a bit towards flexibility. There's this big conversation in the office space regarding hybrid work and return to office mandates and longer commutes. How are those reflected in the Orange County market, if they are reflected? What's the story there when it comes to like flexibility and spec suits and hybrid work patterns?
So as it relates to occupiers, I think we've really settled into return to office mandates. I think we determined mandates don't really work, but you find your productive employees that want to contribute and do a great job and earn a paycheck. And those are the ones that end up staying with the organization. So I think we are kind of settled in as it relates to return to office. I think it's fair to say most people are probably working 4 days or so in office, 1 day or so at their home office or hybrid. I think a lot of businesses have gotten to the point of if you're productive and you're executing, great. And if you're not, then we're going to replace you. So I think it's really down to the brass tacks there versus kind of overarching mandate kind of conversations. So I think we've moved past that, which I think is positive. As it relates to flex office, definitely in space 5,000 square feet and below, probably even 10,000 square feet and below, the space that is leasing quickest is spec'd out. It's high end, it's move-in ready, with very, little work. Maybe you're adding a few offices, you're fixturizing, cabling, and you can be in 30, 60 days. Now, not every owner wants to spend that kind of capital, right? So that's where we start to see some differentiation in the ownerships and the offerings in the market. But that is absolutely working if as an owner, you're willing to invest the capital. Groups like the Irvine Company and others have also implemented these really easy Flex Plus programs, whereby in a spec suite, you can also for 50 cents a square foot in addition to the rent, you can have your space furnished and cabled, and your company can walk in with your laptops and supplies and be up and running kind of that day. So I would say that is definitely attractive. It's desirable. As we know, sometimes businesses are slow to pull the trigger on a decision and then to execute an entire transaction negotiation and permitting, design, construction, getting into the space. That can be a 6-12 month process, depending on how detailed and how large it is. So having these kind of move-in ready kind of scenarios is definitely desirable. Tenants are responding to it well, and it's helping move occupancy up faster for the landlords that are willing to do it.
I'd like to discuss a bit about asset quality. How much of the market's current performance relies on asset quality? Are Class A buildings meaningfully outperforming older or commodity office assets?
Definitely. I'd say this is not a statistic. This is an Allison estimate. 75% of the leasing activity is in the quality buildings. It's pretty significant. And as you and I chatted about before, a lot of the Class B and the Class C properties are kind of getting their new beginnings, if you will. So a lot of those properties are low rise or mid rise. They're surface parked in Orange County because we are a suburban office market that has a good amount of land. And so when you have a small office building that's on 3 acres of land, for example, there's a residential redevelopment opportunity there, or there's an opportunity for, medical office with adding a parking deck and really re-looking at these. So in the Class B and C space, we are seeing a lot of these conversion type transactions. And I'd say the most prominent is residential. In our market, that's looking like townhomes for sale because that's garnering the highest land residual value, and other uses like churches and schools and healthcare related. And so that is happening quite a bit in the B and C space, where the actual tenant leasing activity is definitely skewed to the Class A, well amenitized, quality type projects.
And what are occupiers asking for right now? Is it shorter lease terms, high-end amenities, walkability, proximity to employers' homes? What's on top of the list, if I
What's on top of the list, I would say, is amenities and employee experience. So people, if they're going to come somewhere at this day and age for 8 hours, 10 hours, they want food they can walk to. They want outdoor spaces that they can have an informal meeting in, or take a break or a phone call. They want places for a quick bite to eat, and then places they can entertain clients and have more business meetings over meals. What else? They definitely want capital. So owners that can provide tenant improvement dollars. I mean, as we've discussed, the construction costs are not going down. So owners that can provide the tenant improvement dollars that are needed are definitely top of the list. And I would say occupiers still want kind of all the flexibility, not on lease term. I would say we're seeing, for the most part, 5, 7, and 10-year leases have become pretty standard if you're, 10,000 square feet and above. If you're smaller, it's still very customary and really always has been to do, a 3-year lease, a 4, a 5-year lease kind of a thing. But I would say across the board, the larger tenants are very comfortable with lease term at this point. They certainly want the most aggressive rent, the most available rental abatement, as much TI capital as available, and then options, right? Options to renew, options to expand, options to contract. If it's long enough, a 10-year deal, et cetera, perhaps a right to terminate somewhere in there. Certainly flexibility is something that dynamic businesses always want. And in a market where it still is a bit more, and again, it's very project and submarket specific, but it is still overall more of a tenant market. And so they can ask for these things. And so our job is really supporting our customers on the occupier side or the investor side, whatever the case may be, in thinking through how to position and present their offering or their occupancy and what that brings to a building owner in a way that is going to be accretive to the other side, but still make sure our client is getting everything that they're looking for.
And to conclude, how do you view Orange County's office market evolving in the next year? And is there anything else you'd like to add that maybe we haven't touched on regarding the market?
I think our story is going to be a little bit more of the same of what we've been talking about. There's really not a one size fits all scenario for our owners. I think our continued the strength of our occupier base and its diversity will continue to be kind of this shining beacon that is special to our market and beneficial. And I think we're going to continue to see a lot of redevelopment and kind of new beginnings for some of these Class B and C office properties as they transition to other uses. So I think stability and growth is going to be part of our story over the next 12 to 24 months. And then again, just the things that we've mentioned, diversity, strength of the occupier base, and a lot of dynamics with each property really being looked at uniquely to what it is and what its opportunity is in this changing environment.
Thank you very much, Allison, for your insights and for agreeing to be on this Step Into My Office podcast.
It's my pleasure, Olivia.
Thank you for stepping into our office. Stay tuned for the next episode of our series in September and feel free to rate this one if you've enjoyed it. For more commercial news, trend stories, and podcast episodes, visit cpexecutive.com. Have a great day, and we can't wait to see you in our next episode.